Hello, thank you for joining us. I just want to ask you, how has 2013 been for you, and what's your outlook on 2014?
Well, thanks for having me. 2013, I think, has remained a very strong year for M&A in the U.S. Certainly, we've been very busy, and certainly in the second half of the year. I think many of us try to think back to 06 and 07 and remember the boom years, but in reality, the U.S. M&A market has been pretty strong over the past 4 years with very consistent levels of activity. And I think what we're seeing now is growing valuations, certainly the availability of capital. And I think that one of the challenges many executives have faced is the wanting versus the willing aspect of wanting to do deals, but not having the willingness to execute and the confidence in light of some of the broader conditions that sometimes undermine that commitment to put capital to work. But all the economic factors are there, and I think the strong U.S. Position right now as it's slowly come out of the Great Recession has been I'd say, a bright light in the global M&A landscape.
Are you happy with the pace of recovery so far?
Well, it's a slower pace than I think any of us would like, but I think that slower pace is partly to be something to look at as a positive. It's built on some strong fundamentals. Sure. It's built on the ability to produce. It's built on effective deployment of the workforce. And it's been the leading recessionary comeback across the globe. So now we see stability in Europe and some opportunities for Europe to begin its movement out of the recession. We've seen a pause in some of the larger emerging markets, Brazil, China, where the growth rates have slowed, currency volatility has increased. And I think currency volatility is something that we're seeing, I think everyone realizes that that is a part of the forward momentum in the emerging markets. I think we had seen some stability and that started to bring a little extra confidence. In reality, volatility is important, but the transition's coming. We've seen new policies in Brazil. We've seen the currency begin to stabilize a little bit. So I think that dynamic is also setting the stage globally for some improved activity outside the U.S.
Outside of the U.S., do you see a lot of cross-border transactions this year? And are you expecting more next year?
Well, with cross-border activity, some interesting things. When I look at the activity in the past year, outbound activity, so U.S. investment abroad, clearly GDP growth in the U.S. at a low 2% is not going to drive a heavy growth factor. So you're looking at those emerging markets with those higher growth rates, right? China was at 8 to 9%. Now it's going to average, along with Asia, at around 6%. You're looking for that growth because one of the things we've seen in the U.S. is we've seen EBITDA and profit growth without revenue growth. And long term, we need to have the revenue growth to drive the real things that are going to move the value. And that's where the pressure is on CEOs now, is to achieve the revenue growth for the long-term strategy. And so when you go outside the U.S., the outbound investment has been still curtailed, mostly due to those aspects of volatility in certain markets. Clearly, China and Brazil are very attractive for many reasons, but the slowdown in the past year has caused folks to temper their attention. The rupee in India and the volatility there has brought India into a different perspective. And so our activity in the emerging markets continues to be dependent on which market, which sector, and the reason to invest there.
What are some good sectors?
It depends on where we are.
Okay.
The consumptive economy in China and Brazil is the first thing that draws people's attention. You have a growing middle class with growing incomes. Whereas you go to Africa, a continent full of many countries, not just one, that has a dynamic playing field, and it's commodity driven right now. But then when you look at what the opportunity is, that's where the next population growth is going to come. And then you take it over to Asia, there's still the supply side story about where you can produce and the labor differential. But that's not the only story. And a lot of really it is about where is the consumption and the demand growing. Because if I flip this around to inbound investment, the investment in the U.S. from non-U.S. companies, that also has been stymied. So even though the U.S. has been a very strong market, the investment from abroad has been curtailed because of those same volatility factors. The willingness to put capital to work when there's a currency deflation going on, when there are local economic factors, has even led where we saw, obviously Japan was a very busy investor this year, but China and Brazil less so, given the home market conditions. They're still going to be active buyers in U.S. assets in the year to come.
Looking for just the U.S., do you think there's anything the policymaker could help out?
Well, tapering is a popular discussion. My view, tapering is something that we all see coming. Obviously, tapering has an effect on interest rates, which has an effect on borrowing. The cost of capital, certainly debt capital right now, is so cheap. And companies are borrowing because they can. The terms are great, the availability is there, the capital's there. We have no shortage of capital to put to work right now. cash on balance sheets, high equity valuations, and debt.
When do you think we'll go back to a normal environment? Normal as in the cost of borrowing is normal.
That's a tough one to predict. I will freely admit that Bernanke is much smarter than this than I am. But looking forward, I'm amazed we've been in an extended period of zero interest for as long as we have. I honestly am. I mean, you look at the effect that has on the economy and what it creates in terms of necessary fiscal policy to support it. I can see us being in a slightly higher interest rate environment through the second half of next year. Do I see us returning to the rates that, what's normal is probably the question to ask.
Well, say 5%, yeah.
Earning something over 1%, I think would be a good starting point. But it's factored in right now, and I don't expect a huge knee-jerk reaction. Certainly the equity markets might have a little bit of a reaction, but again, I think people are starting to bake that into understanding where valuations are these days.
What do you see as the greatest challenge in the M&A space going forward?
I think we continue to see, as certain economies begin to make the turn, obviously Europe and getting through their fiscal crisis was key. Now how Europe plays out of that. Southern and Eastern Europe is a very different place than Western Europe, than Germany, and Northern Europe. So the dynamics of their economic trajectory out of their recessionary period is going to be dependent on how those different parts of Europe respond. Clearly Germany is the strongest country right now, but there are distressed businesses that need to be funded, need to wean off the government support and create opportunities for investment because it is obviously a strong and developed consumer market. Now, continued volatility in currencies is going to be something that I think deal makers are revisiting in terms of how they navigate. We know investment in developing markets is important. We know currency volatility is not something that's going to necessarily remain stable. So how do we navigate that and build that into our longer term investment model, understanding that you can have a depreciation in an investment in the short term, but over the long term that's the right strategy to pursue.
Can you define for us how volatile does a currency have to be in order for you to shy away from deals?
Well, I'll tell you, a lot of folks, the longer term view says the level of volatility isn't critical because over time it's where it's going to play out, right? I've seen on many transactions, currencies and the volatility that we're seeing in some of these markets, moving profitability by 10, 20, 30% in a short term period. I think the key is understanding that risk and understanding how to manage it. I think I've seen many businesses, particularly in global business models now, where they can structure their business so they can build in what I'll call the natural hedge. But when you supply from one market and sell into a different market, your ability to offset your currency risk in the way your business is structured is a way to think about sourcing, using currency as a way to offset those inherent risks so that as one part goes down, you're in parity.
All right. Anything else you want to tell our viewers?
From our perspective, as we look at the market in 2014, we are seeing great momentum in the second half of the year. I think the level of activity that's going on certainly in the fourth quarter, unlike last year where it was a very tax-driven concept, the change in capital gains really drove activity in the fourth quarter of 2012. The fourth quarter of 2013 is more about activity based on fundamentals. About I would say that given where multiples and valuations are, there seems to be a greater confidence in earnings growth, which is behind the forward multiples and the valuations. The ability to deliver the value that's been created over the past 4 years as companies have restructured and built more value into their own business models. And so the second half momentum we're seeing now, I expect to see continue straight into the first half of 2014. And that's why when I look at that positive momentum, I think we're going in a much better direction on a set of more complete basic fundamentals that, the confidence concept is something we keep talking about. The willingness, I think we were seeing a greater factor there. And I think the other thing that's changed, certainly over the past year, is the discussion that we see on the corporate side between boards and their management teams. The discussion around not just the big picture story about why it's a great deal, but the fundamentals of how that deal is constructed and how the management team is going to deliver on that transaction, right? Where's the value possibility? What are the synergies? How are you going to integrate it? When are you going to do it? And making sure that we're achieving those outcomes expected. I think there's been such a greater attention to that. It has affected how deals are getting done. I do see companies being much more focused on developing a very supportable business case, but also executable. And I think that's one of the key things. It's not just about the value you pay, but it's what you do with it. and the execution on these transactions to deliver the value that they have the potential
Like
for.
as in one buys a business, but after the transaction, you need to be able to operate it and carry it.
Right. What you pay is one thing. What you do with it is another. And I think the focus on what you can do with it to deliver that incremental value has gotten a lot more attention earlier in the deal process, in the assessment and the decision to invest, and then quickly right after to deliver that value to shareholders.
Used to be when? Like towards the end of the deal cycle?
Well, I would say I've seen this play out, that the excitement of getting a deal signed often led to a period of relaxation to closing.
Sure, yeah, you closed.
I see much greater use of, okay, we've got this signed, now let's use this time between closing to nail down our plan. So the day we close, we have execution ability, and then we can achieve the synergies, get the impacts that are going to drive the long-term value faster. I mean, we know that time is your least, time is the worst thing that working against you when it comes to a transaction, and particularly when you're talking about people, because the people aspect, the talent. I mean, so many acquisitions today are not just about markets or products or cost; they're about talent, particularly in the technology space. And talent is a very difficult thing to acquire, because it's about culture, it's about motivation, and so the talent aspect just really focuses companies on how do I make sure that the talent that I see, which is key to the business model, is something that I embrace and bring into my organization.
All right, thank you so much.
Thank you.